The Financial Planner, presented by BSC, Investors Protection Fund.
Hello and welcome. You're watching Financial Planner, and today of course we'll talk about your financial planning strategy, what you really need to keep in mind while you're of course determining your goals and determining where you want to allocate your assets. To talk about that, we've got with us Roongta of Apna Paisa, who joins us in our studios. Thanks Mr. Roongta for joining in this afternoon. So Roongta, just to get started, before we, of course, get down to talking about allocating your assets to your goals, tell me about how important is it to have a structured planning of your goals, or to have actually your goals listed out, because a lot of us don't actually do it.
Oh, absolutely. I think, as they say, when you don't know where to go, any road will take you there. So you actually need to know what you're saving for. What is the amount? So first, I mean, people just say, I want to make money. Make money to do what? Possibly to get a corpus for your retirement, for your higher education of your child. You need to estimate the amount you need. Okay. So you need to do it as if what would you need if your child was to have that higher education today. Add a factor for inflation, 8%, 10%, I mean that's an estimate. And that gives you one goal. When you list down various goals, you'll get a list of your goals. And typically for most people, they normally don't have resources to meet all their goals.
Okay.
So you then need to prioritize. Okay. Which of your goals are more important. So I think this exercise needs to be done before you start investing, because depending on your goals, what you invest in, for how long, etc., will completely change.
Mr. Roongta, help me understand this. Yes, you might sit down when you're in your late 20s and decide that, you know what, you want to plan for your future, you're going to list down all your goals. How often does one revisit it? Because your priorities will change every couple of years. I mean, at 28, you'll probably plan for your marriage. At 35, you'll be planning for your kids.
Oh, so absolutely. That is what your planning exercise is, never a one-time affair. Any changes that occur, you get married, you have children, you get a raise, you lose your job, there is a health emergency, anything that happens to you in your social life, your real life or your financial life has an impact on your planning. So planning needs to be reviewed constantly. At the very least, it needs to be reviewed once every year. Okay. And that's why we recommend
once a year.
At least once a year. Your goals and your priorities, because they could change.
Right.
So I think once a year, and that's why we advise that you should seek professional help.
Do you also assign the time horizon to your goals? Because I believe that would be crucial in determining what your goals are, right?
Oh, absolutely. So, I mean, you plan for all your goals. I mean, retirement may be a little bit away when you are young, right. But you could have your own marriage goal, for example. If you have to bear the expenditure, then you need to plan for that. If you have to buy your own house, you have to plan for that. So all those things you will have to plan for. And some goals will be in near term, some goals in the medium term, and some goals in the long term.
So Roongta, you've also indicated that you should put a monetary value to your goals. How does one determine that? I mean, it's not a number that you just randomly wake up and think of and assign that against a goal, right? So how do you sort of factor in what the monetary value should be?
So it is an estimate at best, and the reason it is important is unless you have a monetary value, how do you plan your investments? Right. So I mean, just like the example we discussed, higher education of your child. Now, you absolutely don't know what your child is going to do. Your child is, say, 2 years old, right. And you're planning for higher education when he or she is going to be 18 years.
Right.
You have no idea whether she'll do medical, whether she will do an MBA, whether she'll do it in India or overseas.
Right.
You have to estimate. So you say, assuming that she did it today, and I'm assuming that she will do an MBA course, for example, that will cost X amount of rupees, let's say 10 lakhs of rupees today, then I can estimate. Now, it's possible that she may actually end up doing a medical course, which might be more expensive, or she may not end up doing post-graduation at all. But, I mean, financial planning works on estimates.
Right.
And that's why the review is most important, because as you come closer to your goal, you get a little more clarity.
Right. Mr. Roongta, also in a country like ours, you talk about a 10% inflation. So you might assign about 10 lakh rupees to higher education, which should be about 15 years later. But that 10 lakh rupees 15 years later will be hardly anything.
Absolutely.
How does inflation come into the scheme of things? Because for a normal retail investor, they might not even have that kind of knowledge or know-how of taking inflation into consideration.
So absolutely, two things. One, you take the help of a professional financial planner. That will ensure that all these are taken into account. If you don't want to do that, or don't have access to a financial planner, Microsoft Excel is probably your next best friend.
Right.
I mean, you do 10 lakhs, 1 plus 1.10 raised to the number of years, that will give you the inflated value at the end of 15 years.
And that is very crucial. So one needs to take inflation into account.
Absolutely.
Right. So that is, of course, of how your goals are set. Now we come down to financial planning and making those investments. Just take us through how one should be doing it to begin with. I mean, you've got your goals down. What next?
So, one, you got your goals down. Now you have got specific goals, because you may not be able to meet all your goals. Now, when
So
you
just to come back to it, your short-term goals would be, what does this call of time horizon would be looking?
So anything up to 3 years
Is a
a
short-term
short-term goal. Anything up to 5 years, I would say less than 5 years is short-term.
Okay.
From a retail person's perspective.
Right. Medium term would be?
It would be 5 to 10 years.
And long-term
anything
would be?
about 10 years.
Usually
would be
your long-term goals are retirement. So that's
retirement, children's education. If you start planning fairly early, children's higher education and retirement.
Right.
And children's marriage tend to be long-term
Okay.
goals. Medium-term goals, if you don't
Buying a
already
house.
have a house, I think that tends to be a
and
medium-term
your marriage
goal.
could be about 5 years.
Your marriages or other, buying a car, going on a foreign vacation, those could be short-term goals.
Right. Mr. Roongta, going back to what you were saying, and I interrupted you there. Once you've listed your goals, put a time horizon to it, and of course assign a monetary value, what happens next?
So then I need to invest for each of my goals.
Okay.
So first I do a tally of what assets I have and what liabilities I have.
Okay.
Right? I assign specific assets, existing assets. Now, you can do an exercise by which you say that the existing assets are properly not in a proper channel, you may need to change it. But you need to make sure that every asset, either existing or new investment that you are making, needs to be assigned to a specific goal. That's extremely important in terms of maintaining discipline. Because imagine, you've got now separate investments going for retirement, separate investments going for your child's higher education, an emergency crops up. Moment an emergency crops up, if you are eating into something that you are saving for a long-term goal, you know what exactly is getting affected.
Right.
So if you want to go on a holiday and you think, oh, this investment is lying around, why don't I borrow from there? When that asset is specifically earmarked for your child's higher education, you know you're going on a holiday at the cost of your child's higher education. That tends to maintain discipline. Also, you tend to know whether you are up to speed on your child's education or retirement or whatever your goal is. So having specifically allocated assets, whether existing or future, is important.
Right.
The second step could be, for future, what do I invest in? And I think that depends on your time horizon and your risk profile. And typically, the longer the time horizon, your risk profile can become higher. Even for the most risk averse, as the time profile increases, your ability to take risk will definitely increase.
Right. Mr. Roongta, also what I want to understand from you, I think this is a common mistake a lot of people make, is where they will plan for their short-term goals and they say, you know what, maybe 10 years later we'll start planning for our long-term goals like retirement of your child or, you know, your child's marriage. How do you fix that psyche? Because you can't be looking at just one goal at a time, right? It's all about multitasking at the end of the day.
It's not even multitasking. I mean, all those goals are going to come up, right? And as they say on the side mirrors in a car, that the objects are closer than you think. I think similarly, your 10 years are much closer than you actually think. They're not really a lifetime away. If you don't plan simultaneously, if you leave it till too long, the amount that you now need to allocate after 5 years will be humongous, and which may not be within your resources.
It's always easier to start early.
It's always, you start early, that itself is 90% of the battle won.
Very quickly, just to allocate assets towards your goal. So if you've got a short-term goal, what is the sort of assets would you allocate here? Medium-term goal, what is the sort of investments would you make? And for a long-term goal, what is the sort of investments one should be looking at?
So, I mean, to give a very standard prescription somehow is not correct, because it's individually for individual customers. But if you were to ask for a rule of the thumb, any goal that's more than 1 year away, 2 to 3 years, I would say 80, 90% debt, 10, 15% equity. Any goal that's 3 to 5 years, we would recommend a balanced fund. That's roughly 70%, 75% equity, 25% debt. Anything more than 10 years, I think your equity component can really rise, and debt You can have debt, you can have gold as well. Especially when you're saving, say, for a marriage or for retirement. Maybe a 5% allocation to gold or a 10% allocation to gold is not a bad idea.
Mr. Roongta, also, I mean, would it be fair to say that your investment plan should be only determined by your goal and not by the environment, the global environment or the domestic economy, or how the equity markets are performing or how the bond markets are performing? So that shouldn't come into your thinking process.
So there's a lot of noise happening every day, and unless you are able to filter out that noise, I mean, a retail investor, there is no way a retail investor can keep on top of what is happening in terms of his investment. So the best way for him is to do a systematic investment month after month, irrespective of what is happening in the market. That works well for goals that are 5 years or more away. Anyway, for less than that, the debt component is much higher, and there the risk is also much lower.
So, Roongta, another point that you've highlighted here is that one should look at high absolute returns rather than calculating annualized returns. Can you elaborate a little bit more on what you mean by that to begin with?
I think it's reverse. I mean, you should always, we have this mistake that most people make, which is called the law of large numbers.
Okay.
So you have, we had a client who came in who said, you know, my father is a great investor. 30 years back, he put in 3 lakhs in a plot of land that was sold last year. In 30 years, it grew 70 times, 2.1 crores it became. Is that a great investment? So we listened. He obviously felt it was a great investment. But when you calculate the return was about 15.21%. Now, not a bad return by any stretch of imagination, a pretty good return. But I would not, I would hesitate to classify it.
Right?
No, 15.21 beats inflation.
All you're getting is 5% on top.
5% is a pretty big
number.
Is it?
Okay.
I mean, trying to beat it by more than 5% is always going to be pretty tough.
Right.
You know. But the key issue is that it was not, I would not say it's a great return to the extent that he felt it was such a great return. It was a good return, even I would say better than slightly good return, but not a great return. So I think he was mesmerized by the numbers, 3 lakh becoming 2.1 crores. And I think this is a mistake. I mean, if you look at the entire investment cum insurance industry, that is sold like that. Invest 10,000 rupees every month and you will get 2 crores. Very few people sit down to calculate. When they calculate when they do the math, they find out the return is 4%, 5%. So I think not calculating the return, just looking at absolute numbers, nobody can form a mental picture of the compounded annual return, especially over a long period of time. Not even me. So you have to sit on an Excel sheet to work out that or seek professional help.
So Roongta, also, you know, what in your opinion is the average annualized returns that one should be expecting for the long term? So average CAGR is what I'm talking about.
So I think one should have very reasonable expectations of what kind of returns you will get.
And different asset classes will obviously
have different assets, and tax is a big implication. So I mean, any assumptions you make is dependent on the tax situation continuing as it is. Today, any gains from equity over long term are free. Now, that is today. Tomorrow that may or may not remain true. PPF is today free, tomorrow that may not remain true. So I mean, you assume a stable regime. And you assume certain interest rate also you assume, although there will be a little bit up and down on interest rates, you assume a reasonably stable regime. So I think based on that, over the long run, if you can get if you have a large component of debt, okay, or if you have say 30% debt over 10 years, if you have 30% of debt and 70% of equity, 12.5%, 13% return would be a pretty good return. If you have 90% equity and 10% debt or even maybe gold, I think expecting a return of about 14% or 14.5% is fine.
Right, that's of course advice coming in on financial planning and how you need to allocate your assets to your goals. So evidently planning your goals and of course revisiting that frequently enough is the key to creating wealth in the long term and of course meeting all those aspirations that you have. We'll take a break on that note. We'll come back and take up all your financial planning queries, so stay tuned.
The Financial Planner, presented by BSC Investor, presented by BSC Investors Protection Fund.
So Roongta, we've got a query coming in, and this one says, it's from, of course, one of our viewers who says he's recently started investing in 5 different monthly SIPs. Rupees 6,000 in ICICI Prudential Focus Blue Chip Equity Retail, Rupees 5,000 in Fidelity Equity, ICICI Pru Dynamic and HDFC Prudence, Rupees 3,000. And, of course, Birla Sun Life Frontline Equity and 2,000 Reliance Gold Savings. He wants to know whether this is a good portfolio to build a corpus of about 20 lakh rupees in 5 years.
Yeah, I think the funds that he has chosen very heavy on equity.
Yeah, it's only equity, right?
I mean, you've got gold of 2,000 and HDFC Prudence, which is a balanced fund, which is 5,000. So out of 26,000, roughly only 2,000 is gold, and another 1,500 out of the HDFC Prudence allocation is towards debt. So around 3,500. That's a 15% or 20% exposure to debt. Balance is towards equity. Funds are good. The amount he is investing should, if the returns hold up, he should be able to get it. Among the funds, I mean, the only one that I could advise him is this Fidelity, which has performed well, but the management has recently changed. So maybe that's something you need to keep an eye on. And maybe switch. So that's the only advice as far as that is concerned. A bigger advice is exposure to pure equity itself for a period that's only 5 years is a little too risky,
right,
in my opinion. So maybe he need to have more, like HDFC Prudence, he needs to have more balanced funds. Maybe Birla Sun Life 95, HDFC balanced, or even a Reliance regular saving fund balanced. So maybe apart from instead of one of or two of these funds, which are good, it is just that the exposure is pure equity. Right. Whereas he should reduce it a little bit, and he should be able to reach, even with a balanced fund, he should be able to reach his goal of 20 lakhs.
Right. Mr. Roongta, also as he gets closer to that 5-year deadline, should he sort of then start switching completely away from equity? Yeah,
so see, that's the issue with a 5-year goal, right? Because if you need switching, I mean, he'll need to start switching at, say, 18 months away. So the amount of time that he has to grow on equity is about 3.5 years to 4 years. So I think that really is the issue.
Right. Well, we'll take a quick break on that note. We'll come back and continue taking up financial planning related queries.
The Financial Planner, presented by Protection Fund.
Welcome back. You're watching Financial Planner. So, Roongta, we've got another query coming in, and this one is by a viewer who says, which is the best option between SIP and lump sum? I have seen lump sum investments beat SIPs over the long run. What do you suggest?
So, well, I mean, if you do a normative study, which we have done at Apna Paisa, what we've done is we've done a study over 17 years, right? And we're talking of a minimum investment of 10 years. So if you were to do a systematic investment plan of a fixed sum over any 10-year period starting from Jan 95, okay, the average return on the Nifty, we did this on the Nifty, we've done it on mutual funds as well that have existed for 17 years. If you did it on the Nifty, your average return was around 18%, a SIP.
Okay.
Okay. When you did the same as a lump sum, if you invested into the Nifty on any day, but for a minimum period of 10 years, right? For 10 years, if you invested, your average return was 14%.
Okay.
The minimum return, if you did a lump sum, was 6, whereas the minimum return in a SIP was 9. Max was 27 in a SIP, and the maximum return in a lump sum was, I think, around 19 or 20%. So the point is that whichever way you look at it, a systematic investment plan over a sufficiently long period, and I in this case 10 years, will always beat
a lump sum. Because you have to take advantage of what the market moves.
Absolutely. You're not timing. So
and you can't time. I mean, a retail investor does not have the bandwidth to time.
Yes, you'll have to be incredibly lucky to be able
smart.
to time.
Mr. Roongta, we've got another query, and this one is by a viewer who says he's made 3 investments of rupees 10,000 each in Bajaj Alliance in 2007. His agent tells him that from an NAV of rupees 17.5, his investments have reached an NAV of 18.5. Should he redeem or wait?
So not very clear what his question is. Is obviously, I think he's put money in a ULIP plan.
I think so too, yeah.
Right? I think this way of calculating return, that the NAV has gone up
Unit is a
from
long-term investment tool anyway.
first. But even to calculate what return he has got, this is meaningless information, because at what NAVs has he invested? How much have been the charges? Okay, I think none of that information is there, and I think he should clearly seek professional guidance before he makes investments. The fee that he would pay to a professional advisor, okay, the benefits he would get will far outstrip. He will not have to get taken in by
what his agent has to
what
say.
agent has to say.
Investment Ladder, presented by BSC, Investors Protection Fund.
Right, that's the advice coming in for you. If you're watching us, well, that's also the time we have on this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by BSC, Investors